Alex Anderson, for those of you that don't know me or don't know my voice or recognize me by face. I know many of you probably do. I'm the director of the equity team here at Time Equities, and we'll be moderating this discussion with Time Equities founder, chairman, and CEO, Francis Greenburger. Before we get started today, I just want to mention a couple expectations, for the next, 45 minutes to an hour of discussion that we're going to have. Due to compliance reasons, we're going to try to keep this conversation to a more high-level, general real estate outlook, Time Equities portfolio oriented. I know many of you on this call have invested with us, over the years into various different funds and 1031 exchanges and so on and so forth. However, we're not going to be able to address specifically the questions pertaining to those entities on this discussion. With that said, Jack, if you could enter into the chat box or the Q&A, both mine and your email addresses and phone numbers, we'll happily field any questions pertaining to any funds or 1031 exchanges, after this call. With that said, I think, we're now almost a year into post-Zoom, so we should all know how to use the chat and the Q&A feature here. So we will be fielding calls at the end of or questions at the end of this. So please feel free to enter any questions you have that come up throughout the discussions, and we're going to try to get to as many as we can. And of course, for the ones we don't, we'll address later on. So good morning, Francis.
Good morning, Alex.
Thanks for joining us.
Pleasure.
So why don't we just get started off here, and why don't we do a quick rundown of how Time Equities portfolio evolved throughout the course of 2020, which was quite a roller coaster. Between January, February was normal, as if we were coming out of a very good 2019 year, and then all of a sudden the pandemic hit and everything closed down, and there was of course the reaction to all of that and the reopening or the attempted reopening of various different submarkets and asset classes, and where we find ourselves now, being that there's a vaccine in place and things hopefully are on the up and up.
Well, of course, as all this unfolded, like I imagine every one of our investors and stakeholders, we all were trying to imagine what this meant. It was an unprecedented occurrence for all of us. And I would say that what transpired, for the most part, parts of it, things were what we expected. Other parts were different, and then there were some unexpected positive outcomes that we couldn't necessarily have counted on going in. I think the trends that emerged are homes became, more valuable to all of us because we spent more time in them. Industrial sort of continued on its trajectory as U.S. Domestic industrial production continued to increase. And certainly as we saw supply line interruptions, certainly international ones, the need for domestic industrial manufacturing output was re-emphasized. Last mile warehousing for e-commerce sales was continued to gobble up space, although a lot of that is purpose-built. Office, we had the new or not so new invention called Zoom, which has all now become part of our lives, which made work at home more practical. And we're sort of evolving through understanding what that means both in a pandemic world as well as a post-pandemic world. And how will the balance between in-office work and at-home work come out, and what's the implication for office space? And lastly, in the retail segment, well, of course, everybody stayed home, so retailers that were selling food or any component of that were permitted to stay open. Others, like fitness centers and certain special uses, were required to close. General merchandise stores sort of dependent. There were, and of course, there were differences in regions. Certain regions closed down at certain times, and other regions opened up or remained open. So for our portfolio, which covers all of that, I would say the result is what we expected, or in some cases, better. Not what it would have been pre-COVID, but I would say that there were some positives that came out of the period as well. We're just now getting our year-end numbers, and we'll see that expressed as we review those and look at them in a broader context. But generally, some things performed as we expected them to, and some of them outperformed. Not too many underperformed our revised expectation or our pandemic expectation. So that's a very general sense of how I view the market, and we'll get into more specifics, I imagine, later in this morning.
Okay, no, that was very helpful, and I think that was very valuable for everyone to hear that. And of course, the year reports on the funds and everything and the exchanges will be coming out probably the next 30 to 60 days as we go through those financials and everything. All right, so switching gears, let's look more toward the 2021 outlook and kind of walk through the individual asset classes that you just kind of ran through right there. Let's start off with office. Now, of course, demand for office space will continue to remain uncertain as occupiers plan for gradual reentry to the office or their offices throughout 2021, and they reassess their staffing and spacing requirements. As you just mentioned, TI's portfolio, specifically in office, expands across different submarkets of the U.S., but also internationally. Being that we're now kind of in this post-Zoom mode, can you comment on how you foresee office leasing going forth this year in terms of, will there be more absorption in the marketplace? Will rents fluctuate because there'll be more space, or will there be more of a demand for more office space? I'm throwing a lot of questions at you, but
yeah. So
really, what are you forecasting for that?
So as I mentioned, we're in what I call, as much as we'll hopefully soon be in the post-pandemic period, but I really think of this more as the post-Zoom period, because that is the long-term game changer that we have to try to understand. The answer is we don't know 100%, but we know some things, which I'll share with you. Gensler Architects, it's the largest architectural firm in the world, did a survey of how people feel about working in the office. And the responses were a bit counterintuitive. 86% said that they wanted to work in the office. 14% said, no, they want to work at home full-time. Of the 86%, I think about 38 or 40 said that they want to work 4 days in the office and 1 day at home. And the other, whatever it is, 40-odd%, wanted to work at home between 1 and 2, or 2, maybe 2 days, and be in the office 3 days. So a big vote for in-office work, contrary to what maybe people thought, oh, everybody wants to stay home. And when they asked people why they felt that way, they expressed one overall sentiment, which was they wanted to be in office work for social reasons. And then they said, well, what kind of social reasons? Half the people said sort of personal socialization. They like their coworkers. They like the fellowship that occurs in an office context. And the other half said that they wanted to be there for social business reasons, to interact with customers or other business contexts rather than somewhat personal context. So that's interesting and telling, and of course how that plays out is going to be important. And if it holds true, it suggests less of a shift than some people might have imagined. We also know that there are questions about productivity. Goldman Sachs had told its traders that they could work at home through the end of the year. However, in September, they all got called back to the office on a 3-day notice or 2-day notice because Goldman Sachs noticed that their productivity had declined. So that's also going to be looked at by businesses. How productive is at-home work versus in-office work? Issues of accountability. And another thing that I've noticed on a personal level is that there's kind of the informal brainstorming that happens more easily when somebody is proximate and you say, oh, hi, Mary, hi, Bob. How do you feel about this? Or let's talk about that problem or that challenge, or how do we respond to this? That happens on Zoom, but Zoom has a certain intentionality about it where, people have to make a Zoom appointment and it's all very deliberate and usually with a clear purpose, unless it's a personal social call. All of these things are going to inform the absorption of office space going forward in the post-pandemic period, which we hope will begin later, certainly by this summer. In the meanwhile, businesses are indecisive. So we're seeing some businesses who had lease expirations come up asking for 1 and 2 year extensions so that they can sort of judge what their needs might be. Will they downsize somewhat, or what are their thoughts? And we're accommodating, and I think most owners are. On the other hand, we've also signed some long-term leases where people have made commitments for 5 to 10 years, rented new space during the pandemic. So the jury's far from out. Another indice of the office situation is interesting to me. Last week, we closed a mortgage on a suburban office building that we own outside of Cleveland. It's very well located. It's a high quality building. And we had leased it up. We bought it from a bank who was moving their regional headquarters out of it. And we leased it to a couple of good companies, not AAA credits, but good credits. And we went in the market for financing and closed about a week ago. And I was astonished at the rate of interest that we got on that mortgage. We got a 10-year mortgage at 2.7% interest only for the 10 years. And interest only, of course, means there's no amortization, so we're not paying down the debt. So what the judgment of that bank or institution was that they felt this asset was going to perform well for the next 10 years. And they're even not concerned beyond that because otherwise they would have wanted it to amortize. So a lot of different views out there. And I think the jury's far from out. Of course, to the extent we go into an economic recession, that could affect office demand. But that's more cyclical and usual than kind of structural change that we might expect from change in the balance between in office and out of office. So it's a lot of information, but I hope it answers your question.
No, it definitely does. And personally, like you said, I really enjoy being in the office. I find myself to be tremendously more productive there, and just purely just from a interaction standpoint with my team and the legal department and the acquisitions guys and everything. So I can't wait for it to be just, everyone's back, we're all good. I have family and friends who, unfortunately, their companies haven't even, opened up the office yet, and they're going crazy. They're like, we want to go back to the office so bad.
I hear that a lot from people with young families. They say, I love having, of course, more time with my kids and families, but frankly, it's really, really hard to work. And I'd like to be able to go back to the office, and then when I come home, be able to give my family 100% of my attention rather than have them, distracting me and my sort of half being there and half not being there.
Yep, no, I agree. All right, so let's move to retail now. I was reading a CBRE research forecast the other day in preparation for this, and they basically explained how brick and mortar retail sales are expected to grow in 2021 as e-commerce sales decline after the COVID surge. In addition, new opportunistic and emerging retailers will capitalize on market conditions to absorb some of the vacancies from some of these bankrupt retailers, which especially in New York City, there's been many of those. You walk around and there's just store closures everywhere. In addition, on the mall front, there's adaptive reuse and conversions that could play into the repositioning of some of these assets, which have been the hardest hit by COVID. As of today, given everything that's happened, and of course we were fighting the uphill battle with the e-commerce dynamic with retail back in 2018, 2019, and now all of a sudden we have this kind of COVID concern, going forth into the future. Are you still a buyer of retail assets going forward? And if so, has your acquisition criteria changed much with this added, COVID and or a future pandemic dynamic occurring?
Well, I think the retail story, and you've done a good job of touching on a number of the relevant points, is also evolving and has not yet been fully defined. Of course, it was evolving before the pandemic too. Now CBRE, I looked at their report briefly, but I haven't taken it in full depth, so I don't understand. I don't have the full information of why they're predicting decline in e-commerce sales. But anyway, we are seeing a lot of innovation going on in bricks and mortar retailing, whether it's central pickup, which has worked very well and consumers like, so they get the benefit of immediate and certain delivery, but at the same time they don't have to go into the stores necessarily to get what they want. They can pre-order, as well as retailers that e-commerce retailers who are going multi-channel and realizing that bricks and mortar could increase their sales as opposed to direct online. So there's a lot going on, a lot changing. Obviously we'll be observing that keenly. But the one part of retail that has not yet solidified is the debt markets, the financing markets. And right now we're seeing a reluctance to finance retail. And that will certainly be relevant to our decisions about whether we purchase new retail opportunities or not. We had a couple of assets that we were in transition that didn't have debt on, that actually we had debt arranged that banks canceled their LOIs as we went into the pandemic. We're just about to close financing on one of them from a regional bank lender. The other one has been another lender has stepped up, said they want to do it, but they're waiting for a couple of things to come together. So the liquidity would have to return to the marketplace for us to be confident about new purchases. And of course, we'll be watching these trends. Generally, there, and I can say, again, I haven't had all the financial reports yet, but you know, our retail portfolio either met expectations, or our pandemic expectations, or exceeded it. So it wasn't you know, all it wasn't a wipeout by any stretch of the imagination. And yes, bankruptcies of some retailers were accelerated, but honestly, when we bought the complexes that we have, most of those retailers we marked to zero, and we're expecting, you know, to go bankrupt 5 years ago. Sears, J.C. Penney, people like that, and we actually ended up getting income that we didn't expect because they held on. You know, now they finally did what we thought they would do 5 years ago. So it's also an evolving story, and depending on liquidity and depending on how strong the center is, we might purchase new ones. We'll judge the opportunities the way we always do, and try to look at the macro picture as well as the micro picture of the particular asset. Certainly centers, you know, that were grocery related, you know, they actually had increases in business because, as I mentioned, people were eating at home, so they were buying more groceries. So it was a boom time for groceries, and also, you know, retailers that had a grocery mix in them. So the picture is, as I say, things performed at least as good, if not better, than we expected.
Okay, well, thank you. So industrial, that of course has continued to remain a hot topic of discussion over the last couple of years, kind of alongside multifamily, if you can pin the two up next to each other. And this is, of course, due to the increasing e-commerce demand, which of course then feeds the need for an increase in warehouse and distribution space. More recently, I think the conversation has also shifted towards, you know, retail to industrial conversions, whether that be as part of a strip center or a mall or whatnot. What is Time Equity's approach towards the competitive industrial asset class today, considering that in many cases it could be the capitalization rates can be compressed and we just may not be competitive from a yield standpoint? You know, the Bridgeport, you know, strategy has been probably a perfect example of how we've kind of pivoted away from the typical industrial asset class and gone to something more unconventional.
Okay, well, in my mind, industrial or warehouse, there are really two separate asset classes. One is last mile fulfillment centers, which serve the e-commerce market. And a lot of those are special purpose built, meaning they're newly built for particular e-commerce vendors. You know, Amazon, of course, has built an enormous number of immense structures around the country. But as you pointed out, Alex, the cap rates on those have been very compressed, sub 4, 3, and frankly, we don't see a great opportunity in those because of the very low cap rates and high prices, and that there's a risk inherent, of course, when you pay a lot of money for an asset. If it doesn't perform exactly for what you intend, you won't even achieve the low return that you're buying into, because the fact that you paid such a large price per foot for it often right well above replacement cost, you're putting yourself in a perilous position. So we stayed away from that. However, we have been buyers and continue to be buyers of industrial assets that can either be used. We tend to like ones that have a lot of small and medium-sized tenants, because what we see is as these businesses cycle, some outgrow their space, move somewhere else, some go out of business. But when that happens, the other businesses in the industrial center tend to grow and have expanding needs. So the dynamic almost creates its own demand. And our properties, we bought several that are, for instance, proximate to airports, have performed well. In deep economic cycles, they've had challenges, but they've worked through them, and at the moment they're performing very well. We're sort of sticking to the sort of more bread and butter industrial, sometimes warehouse, sometimes mixed industrial and warehouse, flex space. And we'll certainly continue to buy that because, as I say, I think there was already a trend towards increasing American production of goods. And I think that the pandemic has shown the vulnerability of the international supply chain and should only increase and encourage that trend. So we'll be bullish on industrial, but only where we can buy at more traditional cap rates in the 7 to 8% unlevered return area, or where we see a major repositioning position. You mentioned one of the Bridgeport properties that we bought. That's more complicated because it has a lot of surplus land and there's land redevelopment, and that's really a whole redevelopment plan. And we also recently did one sort of similar to that in Holland. I'm all for good bread and butter industrial and warehouse. Prefer smaller tenants so that I don't get left with a 500,000 foot empty box, even if I have a good tenant there for a while, because if they disappear, it's a very large empty vacant building. If I have 100 tenants, a couple go out, a couple come in. Occupancy may go from 90 something to 80 something, but I'll be able to live through the storms. If I lose 100% of my income, that's more challenging.
Makes sense. And one thing actually, I think it's going back probably, I think when we were talking about, it was going back a couple of years, when we were talking about the Miami Industrial Park. And I mean, I think that's close to 1 million square feet just in itself. And just due to the sheer size of some of these industrial assets on a square footage basis, if you have any sort of incremental rent increasing by 25 cents, 50 cents, $1, that can add a huge number to the bottom line just due to the fact that you're just multiplying that by the sheer size of the square footage of the facility.
And it's really the internal growth in that property, as you know, it's about, I think it's 800 or 900,000 feet, but it has 200 tenants in it. So the average tenant is 5,000 or 10,000 square feet. So those tenants are growing. Sometimes they're moving. Sometimes they need more space, and sometimes they're going out of business. But it's a very livable dynamic. And as long as we have an adequate vacancy built into our financial projections, it's highly sustainable, as opposed to, oh, I have a wonderful occupied building today. Oh, today I have a 500,000 foot empty barn. So we like, and that property is a good example. When we bought it, rents were, I think, around $6. During the first few years, they got up as high as $9. And then we hit I guess, 2008, 2010, World Financial, our occupancy went from 95 to 80 or 78 or something. And the rents declined. I think rents went back from 9 to 6 again, even 550. But we got through it. And now rents are trending up towards 9 again, and our occupancy is 95%, and as healthy as can be, and have remained so throughout the pandemic.
Yeah. All right. So finally, let's get to multifamily. Of course, I think we can all recognize that the urban submarkets, particularly in gateway cities like New York, San Francisco, Miami, Chicago, have been hardest hit by the pandemic, but will likely, provide for longer-term upside potential as people begin to cycle back into these urban environments. Overall, will the multifamily sector and investment activity continue to perform and provide good opportunities? And how is Time Equities positioned to take advantage of this type of investment activity?
All right. Well, multifamily, as I say, homes became more valuable during the pandemic because people were spending so much time in them. We saw in most homes that occupancy rates stayed high, with one exception, which I'll get into in a minute. Where you didn't have economic groups with a lot of job loss, rents were paid, and multifamily segment performed very well through the pandemic. Concurrently, we had this phenomena of very low interest rates. And at Time Equities, we were able to take advantage of that in a number of cases where we refinanced. And I think the range of refinance, the lowest rate we got, believe it or not, was for 10 years, 2.34%. Incredible. Never in my wildest dreams would I have ever imagined such a low rate. Fixed for 10 years. That was a little bit of a special loan. It was a Fannie Mae, what they call green loan, and included a commitment by us to bring some additional environmental saving features to the complex. But we closed at least half a dozen refinancings ranging from 2.34 to 2.75. Extraordinary interest rates that obviously enhance the cash flow of those properties. At the same time, it's not like the world didn't notice this phenomenon of low interest rates or the desirability of residential, and cap rates compressed. So they were already low, they went even lower. So that means that average cap rates on multifamily today are in the 5s. Better quality, but not the best, are in the 4s. And I've even heard brokers in Austin, Texas, places like that, talk about 3s. So obviously those are very low returns, and it's hard to make a margin. In the 5s, if you've got financing at anything below 3%, well, there's some positive leverage there, and you can convince yourself that that's manageable. Below that, I think you're cruising for a bruising, because one day you'll have to face the reality that rates will not be that low. And what do you do then? Jump off the boat? I mean, so one has to be very cautious when rates compress. As I say, in the 5s, which often means 6, but then when you take out reserves for replacements and improvements, things like that, it gets down into the mid-5s for good quality that you can finance at 3. Okay, I get that. Much below that, it doesn't make sense to me. One of the things that the low rates of financing, however, are bringing is new competition, and we have to pay attention to that as well. They permit the cost of the ownership, the home ownership cost to go down. Obviously, with lower rates, mortgages are lower, and people can afford more. So what we're seeing is a massive boom across the country in single-family homes. Builders can't build stuff fast enough, that's a very, very positive area, house building and home sales. Those people are moving out, typically, of multifamilies. So that creates a bit of a drain on tenancy. You have to pay attention to that as well. And even in the construction of multifamily, when rates get that low, it spurs building because it's more new development becomes economically feasible because of the low rates. But every time you build something new, of course, you create competition for the old. So, I think it's a good opportunity in multifamily at the moment, as long as you're not going too far down in cap rate compression, but keep your eye on the supply, and it should be, an important part of a balanced portfolio, but it's not without risk. Demand will be there, but supply will as well. So those are my thoughts. Just to mention, New York City, and when we talk about urban areas, New York City and San Francisco, they're in a cycle of their own. New York City, obviously a market that we know well, which previously was an extremely favored market. Cap rates were the lowest in New York City, probably in the country, except maybe for San Francisco. And here, we've seen a phenomena, frankly, mostly in Manhattan, much less so than in Brooklyn or Queens, where we've had unheard of vacancy rates in Manhattan. Used to be vacancy rates in Manhattan would be 2-3%. We're now seeing 20% and more. The reason for that is clear. New York was, their economy was fueled not only by people living here, but 52 million tourists a year, 1 million a week would come to New York. Of course, they ate in restaurants, they went to theaters, they went to museums and entertained themselves. That whole segment is closed. So those tourists aren't coming, those jobs don't exist, the theaters are closed, the people who worked in the theater, the actors, the bands, the stage hands, everybody, and the restaurants that supported all that are gone. So there's been a big flight of people, younger people have gone home or consolidated in other areas. Hopefully the tourists will come back, and hopefully New York will restore itself. But it's a world of hurt right now. Strangely, we've seen a phenomena though, where lower priced condominiums, which for New York City means 500,000 to 2 million, are selling. We have an inventory of these things. We sell them every day. We sold them throughout the pandemic. So people who are sort of have a longer term commitment to the city are still buying, and they see this moment as an opportunity because of the low interest rates. And a little bit of softness in the pricing of that tier. More expensive so-called luxury in New York, that's trading less strongly. Although recently we've seen a pickup in the trading of very expensive townhouses, which, in New York, a brownstone or townhouse trades for $5 to $20 million, and it's been active. So counter wins, but New York's down for the count right now, and fortunately, we hadn't been buying a lot of things in New York for a long time because cap rates were too low, even when conditions were theoretically good.
Does that still do from the investment side of things, from like multifamily or office or even the retail condos, are you seeing investment values remain strong, or is that going to come down the road where there's going to be a depression in terms of values just because of the time?
Well, certainly rental housing is is significantly discounted now because it's this enormous occupancy rate, enormous vacancy rate, and rents are down. So that market is not, has very limited trading. The sale of individual condominiums, as I said, is different. And there, that 500,000 to 2 million band, I don't see price weakness of more than 10%. And sometimes it's trading at essentially post-COVID, pre-COVID levels. We just put a new townhouse that we had renovated on the market, which we originally had estimated would sell for 3.8. We put it on the market at 4.2. We have 2 contracts out at 4,050,000. This is within 60 days of putting it on the market. People want outdoor space, which townhouses have. It's at a premium.
It's interesting. All right, so we're just kind of skip forward to a question. So thanks for hitting on New York City with that one. As it relates to, one thing that I think a lot of people enjoy about us and like hearing is, of course, our ability to innovate and pivot in times of disruption. No different than what we did back in 2009, 2010. We did the same, here in early 2020 when the pandemic hit, and we identified some special opportunities to invest in. Could you speak about, those as well as anything else that may be on the horizon into this year?
So our whole DNA is being opportunistic, understanding the markets, and trying to see where the best opportunities lie. And even if they're not things that we've traditionally done, we don't go off on adventures where we don't have the relevant expertise to execute, but where we can partner or put that expertise together, we do. So we did see a couple of interesting innovation, new areas for us last year. The first was, even though we don't normally trade in the public markets, I became aware of a disruption that was occurring in a special publicly traded type of stock called preferred stock in public real estate companies, which obviously is equivalent, is more like debt than it is common equity. We noticed that, for example, Brookfield, one of the largest real estate companies in the world, that the preferred stock in their office platform was offering a 10% return. Traditionally, it offered a 5% return. So it was at a discount of about 50%. And we knew, and Brookfield has the best office assets in the country. So it seemed, and if you went to Brookfield's parents' unsecured debt, that was trading at, I think, 3%. So it was a complete mismatch that their more junior bonds should be paying 3%, yet this much more senior in the capital stack was trading at 10%. There was a hedge fund that we knew, had done other business with, and we decided that they had an expert in this area, and we decided to create a special standalone fund for just us, for just our entity, our entities, and we took a position with the hedge fund operating the portfolio for us. And I thought, at a 10% return, if that's the worst that happens to us, that would be pretty good, and we expected to see better. I can tell you that over the last 6 months, the returns have been 12.5% for 6 months, which of course implies a much higher return through the year if prices continue to maintain their current height. So that's an interesting opportunity that seems to be working well. That's something that we normally would never have entertained. Another area that we decided to take a position in were what called B-piece debt. So this is a first, it's it's part of a first mortgage, but it's the junior part. Typically, maybe it's 10% of the mortgage. And the lenders like to have us as a partner in those things because in case there's something wrong with the property, banks are not good at fixing such problems. They like to have experts like us. So typically, they will take a much lower return on their 90%, and we will get typically a return in the 13 to 15% on our junior part of the first mortgage. And we felt that that was a good return for us. And we look at these properties as if we were potentially going to buy them, and we make sure that our lending amount doesn't exceed what we would pay for the property. In fact, it's much less, so that if something went wrong, we would be very comfortable going in and straightening whatever the problem is out and benefiting from doing so. And if things go right, which is what we expect, we will earn a return in the double digits, which we think is very good. And we've done 3 or 4 of those transactions since June or July, partnering with, as I say, a lender who asked us to consider this role. So we're happy about that. I guess the last piece of innovation, although it doesn't have anything to do with, this is more, this is the funds, this is not something that is being, I'm doing more corporately, is we're playing a role in financing wind energy and providing alternative energy power. And again, we found a very lucrative niche where we're not building these wind farms. In fact, I saw there was a big article about them in Texas recently, this morning. So that's another area that's kind of real estate, because you build these windmills. But that's, I'd say, not something that we're doing that ourselves, because I don't feel I know enough about it. I know plenty, but I don't want to risk other people's money until I've had a personal experience with it. But it's kind of interesting.
Very cool. All right, so we've gone about 45, 50 minutes on this topic, and I think you've done a great job, by the way, of, I think, answering a lot of questions that I've been kind of seeing pop up on the right-hand side of my screen. So, but I do want to open it up. Jackson fielding a couple. So I'm going to have him come on and relay a few of the questions, and we'll try to wrap up in the next 10, 15 minutes here.
Sure, happy to.
Great. Thanks, Alex. And thanks again, Francis. Thanks, everybody, for putting in these questions. As I mentioned earlier, we do really appreciate your interaction with us here. First question to you, Francis, and we're not going to be able to get to everything, but the first question is kind of an obvious one in my mind. Throughout the pandemic, one of the hardest hit assets has been hospitality in many different ways, shapes, and forms, either publicly and privately. Do you see any opportunity to be investing in hospitality now versus prior to COVID, when we weren't really buying a lot of hospitality as a company at Time Equities?
Well, earlier in my career, I owned 2 or 3 hotels. And I experienced firsthand the challenge that they represent, even in normal times, and how difficult they are. I owned a hotel, a Hyatt hotel in Pittsburgh, through the first Iraq War, and our occupancy went from 80% to 20%. I've seen the pain, and one of the reasons why I decided a long time ago that I didn't want to get involved with hotel assets was because of the dramatic cyclicality that occurs when market conditions get disrupted. And of course, that's what we're seeing now. And there's no area that's experienced more pain than the hospitality industry today. And clearly, hotels are, most of them, vast majority of them have significant financial challenges at the moment. And I'm sure that there are lots of opportunities, or maybe opportunities in them. However, it's unlikely that we're going to go there because, as I say, my concern with hotels is even as they recover, they're a challenge. So you're going to go from a desperate situation to a complicated situation. Stability is hard to maintain. So I see these as high-risk situations, although I can appreciate that today some of the discounts will seem very attractive. But the challenge of repositioning them will be severe. The other thing about hotels is that they don't, unless they are marked down to nothing, it's hard to adaptive reuse, just to recycle them as something else, because they cost a lot of money to build in the beginning. So you might say, well, why don't you take a hotel and make it into an apartment? Well, it's harder than it looks because the hotels are configured with small rooms that are not suitable for, so you end up sort of blowing out all the walls. The cost of building the hotel to begin with, because it costs a lot of money to build that many small rooms, bathrooms, et cetera. So the adaptive reuse turns out to be a lot harder than one would think. And unless the asset was trading for 20 cents on the dollar rather than 40 cents, at 40 cents, it's probably too expensive. It's easier to build new, something that would fit an apartment use, for instance. Offices, depending on the size of the floor plate, they're easier to convert to apartments, but hotels are a challenge, and the cost of them, even at a discount, makes the economics quite difficult, as well as the physical challenges. So, we'll keep an eye on them, but it'd be very unusual for me to get over my concern about the extreme cyclicality of hotels, which, of course, at the moment, there couldn't be a better case for my having avoided hotels for the last 20 years, because this is exactly the moment that I dread. And if you look by comparison at any of the other asset classes, they have their challenges, but it's not like having a hotel that's essentially empty and everything that implies. Sure.
Well, thank you. That was a very well-rounded answer. Next, going to transfer it over to the other side of the pond. As many investors and other people know, we have been investing significantly in Western Europe over the past few years, and in 2020 as well. Moving into 2021, we're looking at additional assets. What is it about Western Europe that you have liked, and that you like continuously as we go into the post-Zoom world that you mentioned earlier?
Well, first of all, although we have a presence in 3 or 4 Western European countries, we don't have a presence in, or maybe 4 or 5. We don't have a presence in a number of the countries. So it's a very carefully thought through risk profile as we make a decision about each investment that we make. We have been heavy investors in Holland. Holland went through a very serious recession that I guess started healing. I've lost sense of time. 5 to 7 years ago or something like that. And that was just about the time that we came into the market. And it was, in retrospect, a very advantageous time. And what we've seen there is that the assets that we acquired have performed well. We've been able to build our portfolio because we identified a certain niche, basically suburban office buildings, which were very hard to finance. So there was not a lot of demand for them. We started buying them all cash, and eventually we identified a non-Dutch lender, a German bank, who understood our strategy and financed them for us. Now the financing markets have become more liquid, and we're working on financing some assets there that we've not financed so far, and possibly refinancing some of the old ones. And the rate environment there is even better than the U.S. I mean, here in the U.S., an extraordinary rate is in the 2s. There, an extraordinary rate is in the 1s. We bought a shopping center recently in there, and the bank, we got I think a 5-year mortgage from the bank at 1.7%. We don't own a lot of retail in Europe, mostly office. The other thing that happened during the pandemic, which I wouldn't necessarily have understood, was that I was speaking with our Dutch asset management office, because we have an office there, during the pandemic. And I said, well, how are rent collections? And they said, oh, I think it was the 9th of the month. I said, well, we've collected 93% of the rents. I said, you collected what? This was like in April or May, when, you know, the equivalent in the US would have been 70%. I said, how is that possible? Everybody's paid their rent right on time. And they said to me, well, you know, we Dutch are Calvinists, and we believe in fulfilling our obligations. So I said, oh my. And in fact, our rent collections in Holland have been excellent through the pandemic. So these kind of cultural elements. So this was a very specific opportunity. It was a disruption in the market that we identified, and we built an effective team to go in, and we have some assets that we joint ventured there, and some that we've now, with our own asset management office, we're running ourselves. It's become a comfortable market for us. And lately, I mean, I can't say that I necessarily anticipated it, although to some degree, I was hopeful that it would happen. The euro has appreciated against the dollar in the last 6 months, 10%. So apparently the world thinks that Europe has something. I mean, the euro this morning or yesterday night was $1.22. I think if you go back a year, it was $1.08. That's significant, and that's a vote of confidence from the international world about how they feel about Europe. So it takes a lot of specifics, but and it has to be country by country. My first European investments were in Germany, and that market became extremely. When I bought in the early 2000s, there wasn't a lot of demand. They were kind of giving things away. Since then, it became very, very popular with investors. Cap rates compressed, and we actually sold more there than we bought. And today, there are no meaningful opportunities that we're seeing for us. In Holland, we continue to see them. We bought an asset in Scotland. We're looking at one in Great Britain. So that's the European story. We feel good about it right now.
Good. Well, thank you for that. I know we're coming up on about an hour here, hoping we can fit in one, maybe two more questions, since I do think they're very relevant right now. First one regarding the recently very popular new developments of mixed use, incorporating residential, office, and retail all in one small center. When you take into consideration new social distancing norms, do you think assets like that are going to be going up in the near future or staying the same or down? What's your opinion on mixed use assets in a post-Zoom world?
Well, I think that there are different kinds of mixed use assets. For example, we're just completing construction in West Palm, Florida, on something you could call a mixed use asset. It's basically multifamily with about 300 apartments stretched over 10 acres. And then there's a retail segment in front. So it's mixed use in that sense. And I think for the people who live there, having access to these shops will create a great deal of convenience and be very attractive to people. And we've just started renting phase one, and demand has been very, very good. And the complex also has very, very strong amenities, lounges, outdoors, beautiful, incredible pools. I mean, you feel like you're in a hotel or something, and lots of areas for kids to play outside. So that's an asset that mixed use that speaks to the success of that model. I'm not sure. I mean, if you want very low density, I guess you go to a single family home model. The one I just referenced is not in downtown West Palm. It's about 10 minutes outside of West Palm, and a lot of the prior residential activity has been in downtown West Palm. And I could easily see people, it's basically an urban-like environment, that they would want to be, out with more open air available. I think any access to open air becomes critically important, even if it's in an urban context. So that means roofs, decks, areas where people can have an outdoor experience. And to the extent that there's the convenience of amenities, retail, I think people want convenience, and they want the option of staying within a context if they can, going out when they want to, but also having the luxury of knowing that there are nice facilities as part of their immediate bubble, so to speak, is the new word. So
Sure.
I think it doesn't speak really to the social distancing question, I think, but it does speak to the post-COVID existence where people feel more secure in open air because we know that COVID doesn't transmit as well in open air as in enclosed places.
Sure. Well, thank you for that. And finally, the last question, something that I'm very personally interested in as well, to hear from your experience. Regarding moratoriums, rent moratoriums, and the occasional or the eventual rolled out lifting of those moratoriums, could you speak a little bit from your experience of moratoriums in the past prior to COVID, and now looking at this new situation that we've gotten ourselves into, how you see the effects of the eventual rolling out of the lifting of the current moratoriums in place, both in New York City and in any other market?
Well, to be honest, I can't recall as sustained an eviction moratorium as we're experiencing now. So this is relatively new to me. I can imagine that this is an issue that will have to be addressed by all the stakeholders, which I would say is the owner, the occupant of the unit, as well as the government. So hopefully there's some sort of phase out where some ability to facilitate if somebody has to relocate because they simply can't pay the rent, that it be done in a measured way, and not that they be thrown out in the street the next day. But they have to take also personal responsibility, and the government has to take responsibility if these people are indigent and without resources. We've had it. It's an issue in some of our buildings, but it's not, at least in the quality of properties that we're involved in. It's not a pervasive issue. So I can imagine that in the lower quality, C quality residential, it's a more severe issue. But I think, I mean, the moratoriums, the government, I guess, didn't know what else to do, and they didn't want to have more homeless to deal with, or whatever motivated their particular decision. But coming out of it will have to be measured and in steps, and a path found.
All right, very good. Thank you. So, any final thoughts as we wrap this up, Francis? You want to give the audience?
Well, I just, I guess my view is that the obvious. Thank God for the vaccine, so that we will see, and hopefully the distribution will pick up where it's not occurring. And I think that's going to be the real answer to the pandemic. And I'm hopeful that by summer, it will be having a dramatic effect, and we'll be over the kind of restrictive protocols that we're dealing with now. I mean, we may still have to social distance, wear a mask, but it's going to be a completely different scenario than where we are today. I also think that the numbers ought to start to fall quickly, particularly the hospitalizations, because we're vaccinating the most vulnerable first. And those, of course, are the people that are most likely to end up in hospitals. So the hospital crisis, I think, will abate within the next, I'm hoping, 60 days. And we will find our way out of it. Hopefully, we'll also find our way through some of the political tensions that are occurring at the moment, and we'll get down to the important business of the recovery and moving forward with our lives in a positive way. Although this is certainly not an experience that any of us would want to have, I think once we get through it, we'll be able to reflect hopefully positively on all that we did to get through it. I'm very proud of our company and the devotion that our entire staff has made to trying to deal with the endless issues that we did as we had to manage through this crisis. And I feel very positively about them and the handling of it. And I'm hoping that our investors can share that experience and feeling, and know that their investments with us have been managed in a highly responsible and highly caring way. We take everything we do at Time Equities personally, and nothing more than the money that our investors entrust us with.
Great. Thank you. And I've been actually getting a lot of messages throughout this entire this hour from people just appreciating your insights and how you've basically handled the last year and look forward to much more coming forward, this year. So thank you for your time today.
Somebody sent me a quote from a famous German author that said, "There's magic in every beginning." And I hope we're at the beginning of the post-COVID period, certainly the beginning of a new year. I'm hopeful that we find the magic and that helps us bring good results to our investors and to all our stakeholders.
Perfect. So that's a wrap. For all the attendees on this call, this has been recorded, so we will be resending this out after we just edit it a little bit.